Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at cannabis brand concentrations and highlights needed for strategic branding, especially in a time of crisis. So looking at recreational cannabis brand concentrations by state from 2017 to 2019, according to the MJ Business Daily and some data from Headset. Looks like most recreational cannabis markets, as they mature, there's a small number of brands that are gobbling up the majority of sales. A lot of that initiates by people walking into a store and saying, what's the highest THC at the lowest price point, and then deciding that that's going to be their brand until it normalizes and people see an advertisement or see a particular brand and say that relates to me. We're not going to kind of see brands sort of becoming popular or normal until that occurs. People are still just kind of looking for how they can get most impaired for right now. So that's not a mature market, but I think we're going to be getting there eventually. And this shakeout with the COVID debacle is definitely going to speed that up a little bit. So brand concentrations, there's a few brands that command the most segment sales. Data from Headset shows that brand concentration in recreational cannabis markets in California, Colorado, and Washington are increasing, and they're seeing the proportion increase most over time in those markets, indicating that the top brands are capturing more and more market share. The article goes on to say that price competition ultimately drives prices down, which can negatively impact a company's bottom line. Yes, of course. Cannabis is no different than any other product, and the top two decision makers are convenience and price. So when Oregon starts selling retail $30 and $40, you're changing the mindset to the customer. It makes me want to drive 3 hours from Seattle to go to Portland and buy an ounce for $30 or $40. But as it is, I think I'll wait until 420. There's probably going to be a ton of deals to go ahead and stock up on. But price and convenience are definitely the two decision makers that most people abide by when deciding on what to buy. Factors contributing to cannabis brand concentrations are difficult to pinpoint, given the fragmented nature of the U.S. cannabis industry, with each state employing its own rules and regulations. However, Nevada appears to be bucking the trend, the brand concentration trend, by becoming less concentrated over time. Roughly 80% of Nevada's recreational cannabis sales occur in Clark County, home to Las Vegas, a city that used to host an average of 3.5 million tourists and I think has 0 right now. Just kind of put that in perspective, the FBI's bomb squad had to have special rules in place to be able to figure out how an IED or an improvised explosive device would happen on the strip, because they couldn't put that practice into reality and shut down a hotel and casino even for 1 minute to test their theory on how that would go down. So they just had their own special arrangement, I guess, simulated. Whereas they can do that all day right now because those are closed. So I would imagine MGM having their CEO walk away and their stock price plummeting. I don't even know how they're going to recover from that. The cannabis company surely didn't expect an entire strip to close. So I would imagine that brand concentration is going to happen a lot quicker than anyone anticipated. So the Brightfield Group kind of breaks down brands and product trends from Canada's 2.0. That's fall of 2019 when they launched their additional products of infused beverages and edibles and concentrate. And so looking at some of the initial trends, basically any emerging state, whether it's medical or recreation, can kind of assume that something similar to what Canada is going through is going to occur in their region. The West Coast, the markets that have already been open have gone through this. And so these are basically brand and product trends that anyone should expect to see to a certain degree. So with Canada's 2.0, for example, you're seeing initial retail stores visits indicating that cookies may have been the most popular infused item, with chocolates and gummies, candies following suit. Gummies have been outlawed in a few states, Washington being one of those, because it's enticing to children. We have a 100 milligram cap in Washington state. Canada has a 10 milligram cap, which is ridiculous. But Those edibles, the sweets, all of those have worked out. And companies that have tried to release healthier options have not succeeded. So hopefully that'll come back around once cannabis is normalized and CBD being a healthy alternative. At least the perception is that it's healthier. Maybe that will come with some less sugary options than just chocolates and gummies and refined sugar. Um, Hopefully we'll be able to see some more options as well as additions to not only low dose or micro dosing at 2 milligrams, but we'll see hopefully individual products that have 100 or more. New regulations are going to see a lot more new products rolling out. So Canada's 2.0 is no different. They've got an opportunity to create innovative products from infused pre-rolls. I don't think those are allowed. Maybe they will be, but at least infused beverages and edibles and concentrates are all new as of fourth quarter of 2019. So a lot of this is going to be new to Canada, like teas and concentrates and vaping. Nothing new to any regulated market or even medical for that matter. Canada was a little bit different in how they rolled out 1.0 versus 2.0. Most of the states will just kind of roll this out all at the same time and allow for the brand concentration to kind of work its way out. Brand differentiation is important because if you're just asking for the highest percentage at the lowest price, you're not going to really remember what it is that you bought. 35% of Canadian cannabis consumers are unsure of which brand they purchased. So, cannabis branding laws are extremely restrictive in Canada, specifically limiting the color and size of the logo and imagery, which may be displayed on a product packaging. So, additionally, promoting any sort of product endorsement or attempt to associate cannabis with an aspirational lifestyle is forbidden, which is why over a third of Canadians have no idea what they're buying. However, partnering with celebrities to form and promote brands rather than product lines could become common workaround, but not in Canada. They're not even allowed to have Snoop Dogg's name on a strain. So they have partnered with Snoop Dogg and Seth Rogen and Drake and Martha Stewart, but they're not able to use their names at all. So we'll have to see how that works out. And in the US, that hasn't worked. In fact, Willie's Private Reserve, Willie Nelson left Washington because nobody bought it. So I think outside of California with Burner, with Cookies or Seth Rogen, Snoop Dogg, Leafs by Snoop. Outside of California and probably outside of just LA, I don't think San Francisco cares. They're more about the medicinal. LA is more about the recreation. And so I don't think even outside of LA, anybody really cares about artists at all. And the numbers back that up. So they do have their following, but all in all, most people could care less about getting a recommendation from an artist. Uh, so 35% of consumers in Canada have no idea. And out of the United States, 37% report celebrity endorsement increases the likelihood of purchasing a new product. So maybe there is a third of the people who actually care. Partnering with an influential individual allows companies to get around Canadian branding regulations. It means gaining credibility still remains less influential among consumers than more personal forms of recommendations. But the Brightfield Group on U.S. cannabis consumption indicates that they find celebrity testimonials to be among the least significant influences in driving them towards new cannabis products. So when a cannabis brand partners with a celebrity, its consumers relate to a 37% increase, whereas 34% indicate that it would not affect their purchasing decisions whatsoever. Other brands are focusing on differentiation with unique branding to build on existing associations in the minds of consumers. So Canada is going to continue to experience its growing pains with the expanded opening of its adult use market. But longer term prospects look positive given the enormous consumer demand for products like edibles and concentrates. And additionally, provinces like Ontario, they're loosening regulations and broadening access to both legacy and new product categories. Hopefully, British Columbia adds to that and opens up some more stores as well. And they increase from 10 milligrams to 100, and that they don't have a lockdown so that people can get access to cannabis. It's been deemed an essential business in Washington and California and places in the East Coast. So they are remaining open with specialty grocery stores and dietary supplement stores. I would expect COVID to have a huge impact on brand concentrates, the concentration of branding, just simply because a lot of these companies don't have the capital to stay in business. There may be some merging, maybe a co-op model on the farms. But I think we're going to see a massive sales pop in fourth quarter as a result of some of these businesses either not manufacturing or, growing, producing, whatever, not making product. So by the fourth quarter, if those companies are in business, the ones that remain will have some decent sales and will result in a higher concentration in brands as a result of companies just not being able to stay in business. But time will tell. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.